Everyone. Thanks for joining us today. We're going to begin our webinar, International Tax, Trends, Risks, and Opportunities. If you're joining us today for CE credit, please note that if you meet the requirements I'll go over in a few moments, you will receive your email within 3 business days to receive your certificate. So some few housekeeping items. You can maximize or minimize the webinar pane during the presentation by using the red arrow buttons. During the webinar, we also encourage you to ask questions. In the webinar pane, you'll see a chat box that you can use to enter your questions. Just type your questions in and click Submit. Our presenters will answer those questions as time allows during our Q&A session at the end of the presentation. Second, to ensure good audio quality, please check your settings to ensure the appropriate audio option is selected. If you're using just your telephone, please click the telephone audio mode, or if you're listening through your computer, then please click the mic and speaker option. Also, please note that you'll be able to download these slides after the webinar. I'll be sending out an email, so don't worry about writing everything down. You'll be able to see them in a moment. So quickly, to go over some California CE credit requirements, you must be using a personal computer, no PDAs, and you must log in with your own information and unique URL. You must be logged into our online software for at least 50 consecutive minutes within the scheduled time frame of our webinar. You must actively respond to at least 75% of the polling questions. There will be 4. And please complete the evaluation survey at the end of the webinar. So now I'll give you a quick introduction to our presenters today. First up is Kevin Wise, CPA. He's partner with our international tax practice. He specializes in U.S. international tax matters for a broad range of industries, including technology, private equity, and the financial industries. Kevin advises multinational corporations on tax matters related to international expansion, structuring of private equity VC funds, due diligence, structuring of acquisitions and divestitures of portfolio companies, and tax compliance-related matters. He's one of the executive leaders of our Transaction Advisory Services Group, advising on structuring of M&A transactions and tax due diligence. And prior to joining Armino in 2008, Kevin was a leader of U.S. tax services for one of the big 4 accounting firms in Canada.
Good morning.
Next, I'll introduce John Davies, who's CPA and also partner with our international tax practice. He leads the international tax practice in Armino, and he specializes in cross-border transactions, transfer pricing, international tax structuring, mergers and acquisition integration, and global earnings mobility strategies. John has a vast international network built on years of experience working with professionals around the world. He has extensive experience in the technology industry, including internet, semiconductor, computer hardware, and cloud services companies. He spent more than 14 years of his 19-year career in accounting at one of the big 4 firms here in Silicon Valley.
Good morning.
You sound impressive.
Excellent.
Yes.
And quick, just to go over our learning objectives, because this is a CE webinar, we'll be reviewing the latest policies and discussions around base erosion and profit shifting. We'll understand trends in choice of legal entities, intercompany relationships, and related pricing considerations. We'll examine several international structural alternatives, and we'll also address how to optimize your global effective tax rates and minimize tax liabilities. And now I'll turn it over to John.
Thank you. Yeah, today we're gonna hit on some current developments that are really still evolving, especially with the OECD and their BEPS, or base erosion and profit shifting actions that have been taken up over the last couple of years. Kevin will talk about those, especially around some of the items and actions that are taking place around digital e-commerce and the digital economy and how the OECD is addressing those. He'll also go over and talk a little bit about what our President Obama has proposed, and also some of the other proposals that have come from the Congress and the legislature with regards to some potential international tax reforms, as well as changes in general. We'll also talk a little about transfer pricing, asking the age-old question of why should your company care, and why do you have to do transfer pricing, documentation, or benchmarking. We'll look at several steps to implement an efficient transfer pricing policy, as well as strategy in general for intercompany transactions. Then we'll take a look at some international tax planning, specifically around intangible property maximization from an international perspective, some of the benefits that can be derived from such a structure, which of course are generally a lower effective tax rate and some management of the IP that coexists or coincides with transactional flows in the business environment from an operational perspective. We'll also talk a little bit about how to evaluate choosing the right structure for your type of business. And we'll also talk a little bit about global expansion in general and how to look at entity choices as well as strategies around that. And after that, hopefully we'll have a few minutes left for questions. Again, as was mentioned earlier, if you do have any questions throughout the presentation, if you can type those into your little window there, and we'll address those at the end, or intermingled throughout the presentation as we get opportunity. So what about international tax? There's some risk with just expanding internationally, but there's definitely some opportunities. As noted here, about 50% of tech companies rank international expansion the #1 priority from a finance perspective, or just in general. And that is because so much of the potential customer base, as well as from a supply side, the base exists outside the U.S. And therefore, you're really, especially in the technology area, forced into becoming global very quickly in the life cycle of a company, even from startup. Another opportunity is that countries are motivated because of the recent downturn in the global economy in the last 4 or 5 years to offer tax incentives, both subsidies, credits, rebates, grants, etc., that can greatly assist companies to expand in various jurisdictions. Another one is the access to human capital, and that really revolves around the ability to find qualified resources at lower rates than in the U.S. And we've seen that migration through China, India, Philippines, to Estonia, Latvia. Across the country, people are desperate in terms of getting qualified talent at the lowest possible price. The risks that are occurring that we see are definitely an increased scrutiny with regards to audits and tax audits. And this is because, given the global economic downturn that we're hopefully emerging from, many of the jurisdictions are on the hunt for tax dollars. And so we are seeing a much larger number of audits of multinational companies in foreign jurisdictions for even the smallest of subsidiaries and presence, whether it be a branch, subsidiary, or other presence in a particular jurisdiction. The other risk that is constantly changing is the tax and regulatory environment in the various countries. On any given day, there's, out of the top 40 countries, there are several tax changes, especially in countries that are seem to have built a reputation as tax changers, like Brazil and India and some other jurisdictions, where they tend to change their tax regulations and rules on a very regular basis. So those are some of the risks and the opportunities that exist around, just from global expansion as well as from a tax perspective on the international side. And with that, let's go ahead and do our first polling question. As you might remember, you do have to answer these questions, I think 75 or 80% of them, in order to get CED. So we'll turn that over now.
Perfect. Thank you, John. So our first question, and John is right, you have to answer 75% of the questions. There will be 4, so that's 3 out of 4 that you'll have to answer for CE. So first question, true or false, the majority of technology companies are considering expanding internationally? A, true, B, false, or C, you're not sure and you weren't paying attention to John's last slide. Give you a couple more minutes, or not minutes, a couple seconds. We'll close the question in 3, 2, 1. And John?
Wow, 100% true. Glad people are listening. That definitely is true. The majority of technologies companies are definitely expanding overseas. And one of the things that they're going to have to address is that of base erosion and profit shifting. So with that, I'll turn that over to Kevin.
All right, thank you, John. So base erosion and profit shifting, they go hand in hand. It's affectionately known as BEEPS in the international community. So it really should be called base erosion through profit shifting, because that's exactly what the countries, every industrialized country in the world, including the United States, is concerned about or perceives that their tax base is being significantly eroded through what they consider abusive tax schemes, or aggressive, at least aggressive tax schemes, particularly offshore IP structures. And so many of the European countries are also very concerned about this. And so the OECD has stepped in and late last year had come out with what they call the OECD BEEPS Action Plan. The OECD is the Organization of Economic Cooperation and Development. It's based in Paris. It's really the UN of economic policy. And so one of the most significant areas that it has influence on is in the area of taxation. And so they came together, and these countries come together. Every major country in the world is a member of the OECD, with some notable exceptions, including India and China. But India and China have been invited to this discussion. And so what the various countries come together and vet the issues and ultimately come up with a plan of action. And the member states are expected to implement the consensus plan that they ultimately come up with. Now, the United States has a special relationship with the OECD. It's obviously a member, but unlike the other members, the United States doesn't or is not expected to follow the OECD, but it does obviously defer to the OECD. And so the OECD came up with this action plan to address these perceived abuses. And one of the other things, though, that's important to note is that the OECD just believes that the global tax system today is flawed. It's old and antiquated, and it has not kept up with modern business practices or e-commerce kind of economy that we live in today. So if we go back 50, 75 years ago, the value drivers of how a company became valuable are much different than they are today. 50 years ago it was based on manufacturing and, labor force and very capital intensive. Today, obviously with e-commerce and some of the largest companies in the world, being software companies or internet-based companies or some form of e-commerce, the value drivers are much different today. And so they felt they needed to come together in a coordinated effort instead of each country in a silo trying to implement legislative changes. They thought a more comprehensive approach was necessary. So what are the key areas that the OECD international community is concerned with? The first is called the hybrid mismatch arrangements. And this is actually one of, I think, the most significant areas that they're looking at. And it also is one of the areas that affords us the best tax planning. So what is a hybrid mismatch arrangement? Well, first of all, what's a hybrid? So a hybrid is any entity or instrument in which two countries view the same entity or instrument differently. For example, a classic example here in the United States is the U.S. LLC. Of course, we think of a U.S. LLC here as a flow-through entity, or what the international community calls fiscally transparent. And but many foreign countries look at the LLC legislation and they view it as having more corporate characteristics than a flow-through entity. So many foreign tax systems view the U.S. LLC as a U.S. corporation and not a flow-through entity. And so that creates this mismatch. You have a different view of the same legal entity by two different jurisdictions. And you can also have a hybrid instrument, typically a debt equity instrument, where one country views the instrument as debt and the other as equity. So why do we care? Well, the governments clearly care, and by this item being so prominent in their analysis today, is because this hybrid mismatch affords us great opportunities for tax savings. Obviously, hence the word base erosion. That our the government's view their tax base is being eroded through these hybrid mismatch arrangements. So, for example, a hybrid mismatch arrangement really derives two essential benefits. One, it allows one party to deduct a payment, usually an interest payment, without the other party picking up anything in the income. Or it allows both parties to deduct the same interest, so a double dip financing structure. So, for example, in a hybrid instrument is a simple example. If a foreign parent, for example, advances money to the U.S. subsidiary, and that instrument is viewed as debt from a U.S. tax perspective, any payments the U.S. subsidiary makes to the foreign parent would be treated as deductible interest. But if the foreign parent views that instrument as equity, any payments on that instrument are going to be deemed dividends. And many foreign countries have a dividend exemption system. And so you have a situation where the U.S. tax base is being eroded through an interest deduction, but the foreign country is not picking up any income, effectively also being tax base being eroded. So the hybrid mismatch arrangements are a great planning tool, but obviously the various governments do not like it. The next item that they're going to address is CFC taxation. CFC stands for Controlled Foreign Corporation. And so that deals with the topic of when a foreign subsidiary earns certain types of income, such as investment income or related party income, the owner or the parent of that foreign subsidiary has to include some of that income in its taxable income. And so many countries have CFC legislation. Of course, the United States has a very strong CFC system. But they vary widely in their scope and in their quality. And so they believe that's ripe for exploitation. And they also want to provide some sort of harmony, consistency across the countries in terms of CFC taxation. Next is excessive base erosion. Or earnings stripping, as we call it here in the United States. As many of you are aware, under 163J, interest expense paid to a foreign-related party is subject to a limitation. Many countries don't have sort of earnings stripping rules, and they think that's a mistake as well, in that there should be some consistency around base erosion through earnings stripping. Lastly, but not least, transfer pricing. The OECD has been instrumental in affecting the policy of transfer pricing, but they think it needs a new, fresh look, and that is in the area of intangible value creation. In other words, they're concerned about having an offshore IP company where the IP owner essentially is just the economic owner, but outsources all its activities such as research and development or sales and marketing, and really has no substance to it. They've always been concerned about that. But they want to go one step further and say, well, how do we allocate profits across the globe, particularly IP income? And so they're going to take a look at that as well. So not to be outdone, the U.S. Also is concerned about BEPS, and yet the Obama administration, the last 4 budget proposals that it came out with included these anti-base erosion provisions. And there's been one that has been consistent throughout each of the last 4 budgets, and that is the taxation of IP income, or what the administration calls excessive returns on IP income. So many U.S. multinational companies, the largest companies, Microsoft, Apple, etc., have several billions of dollars offshore that have been subjected to very little tax. And
even hundreds of billions.
Oh, hundreds of billions in the aggregate, no doubt. And so, so the administration believes that's excessive, and so they believe that there should be some sort of change to the tax code, that excessive returns on IP income have to be taxed in the United States through what we call Subpart F of the code, just basically meaning that if there's an excessive return on IP income in the foreign jurisdiction, there'll be a deemed dividend of sorts back to the United States. But not to be outdone, the Obama administration in 2014 actually looked at the other side of international taxation. So the excessive returns on IP income was concerned with U.S. outbound international tax, where you have a U.S. parent on top. Now the administration has introduced a few items that deal with the opposite, where the Obama administration believes that certain foreign taxpayers are not paying their fair share, and so they've proposed changes to inbound international taxation, where you have a foreign parent owning shares of a U.S. subsidiary. In their first proposal, sounds familiar. It's called the anti-hybrid arrangements proposals, and it's essentially similar, or at least in effect, as to the hybrid mismatch arrangements of the OECD. So under the anti-hybrid arrangements proposals, the U.S. company would be denied an interest deduction if the foreign person that they're paying it to is paid through a hybrid arrangement, and that hybrid arrangement allows the foreign recipient either to exclude the income or to get a second deduction on interest expense. So if there's a double dip financing structure, or the foreign recipient does not have to include it in the income in the foreign country, then the U.S. subsidiary is denied a deduction. They also want to tighten their earnings stripping rules. Again, in the U.S., interest paid to a foreign-related party is subject to a limitation, and the administration believes that limitation is generous. Today, a U.S. company can deduct up to an amount that roughly equals 50% of the company's cash basis EBITDA or cash flow from operations. So they want to tighten that up and change the rules for a certain group of foreign taxpayers. They want to replace the existing 163J with an global interest allocation rule, where you have a consolidated group of international companies. They would share in the consolidated interest expense on an allocated basis, and the interest would be allocated based on relative earnings of each subsidiary. Now, this rule would only apply to multinational companies that issue GAAP financial statements or financial statements in accordance with IFRS. They would also broaden the anti-inversion rules. The anti-inversion rules are rules that came out in 2004, rather. Basically, the rule that they're concerned about is that if a U.S. company is inverted, meaning that a U.S. parent becomes a subsidiary of a new foreign corporation, and 80% of the shareholders of the U.S. corporation are now shareholders of the foreign corporation, that foreign corporation is treated as a U.S. corporation under the existing anti-inversion rules. They think that 80% threshold is too lenient. They want to drop it to 50%. But moreover than that, they want to introduce an additional rule that says, notwithstanding any kind of overlap between the old U.S. parent and the new foreign parent, if the worldwide group has significant operations in the United States and the foreign parent is managed in the United States, that foreign company, again, would be treated as a U.S. corporation for U.S. tax purposes. Lastly, the Congress, this talks about the Ways and Means Committee, but it's also the Senate Finance Committee, have over the last couple of years, like 4 years at least, have had a number of proposals, including proposals on the taxation of excessive intangible income that are similar to what the administration has provided. But one recent proposal, which is sort of interesting, is that the Ways and Means has also floated an idea of having a CFC minimum tax. And, what that would entail is that if you have a U.S. company has a U.S. or a foreign parent or foreign subsidiary rather, that foreign subsidiary has to at least be subject to an effective rate of a benchmark rate. They haven't said the rate, but let's say it's 15%. If that CFC has an effective rate of, say, less than 15%, the U.S. would pick up additional tax equal to the differential, and that would be a CFC minimum tax. And so that's one of the latest ideas that have been floated. I think, before, we leave this topic, I think the thing to keep in mind is that there's a lot of discussion and a lot of, it seems like, momentum in this area of base erosion and profit shifting. However, in different contexts and different ways, these issues have been addressed in the past and discussed, and nothing has changed. Now, I do believe there's more momentum going on today than in the past, and so some of this might hit, but not all of it. And so the rule of thumb is that you continue to tax plan as you normally would.
Yeah, that would be my question, is does it make sense to do international tax planning if all this legislation is being bantered about?
Absolutely not. I mean, if you look at the Congress, right, I mean, we all know that the Congress and the administration are all dysfunctional. And these items have been talked about at least for 4 years, and nothing has happened.
Yeah, no, it's a good point. The other thing is, the OECD a couple months ago issued their first discussion draft on their first action point of 15. So there's 15 action points to the BEPS plan, and they just issued a discussion draft on the first one. So they're really moving along at a quick pace, laughingly.
Yeah,
and
even though they said they're going to operate on a quick pace, but it hasn't come into fruition yet.
Yeah, and in that discussion draft, it basically said, it explained for, I think it's about 60 or 70 pages, but it said how difficult it is to even identify what a digital economy is, or a digital business.
Yeah, good or service.
And basically they said the net result of that discussion draft was that they were not going to do anything separate for the digital economy and do this, basically incorporate it into what all the other sectors were going to do. And effectively nothing occurred. And so when it comes to again, legislation is brought forward all the time. The OECD is constantly putting in place these action plans and discussion drafts and whatnot, but we don't anticipate anything to come out of these discussions and laws, if you will, significantly over the next 4 to 5 years. There just really isn't the...
No, I totally agree. And also I think it's important to note that, like in the United States, the Obama administration, all the proposals in Congress are not getting rid of offshore IP structures. They're just curtailing them. And the same with the OECD. And the reason for that is I think they're reasonably looking at it and say, why is it not legitimate in a global economy that have operations around the world and the income follow those operations, and therefore it's completely legitimate that you have profits in Ireland that have a 12.5% tax rate or lower.
Right, yeah, from an economic perspective, and that's why the economists always have trouble with this is, people talk about this base erosion and whatnot. Well, it's base erosion because those entities are not taking on the rights, risks, and responsibilities that these offshore entities are. And so from an economic perspective, international structuring and these Cayman companies or Ireland or whatever all make perfect economic sense, and that's why it's difficult to draft laws that would cut out just that piece without affecting a huge, broader landscape of companies. That said, we better move on to our polling question. I know we're moving along quickly.
All right, so polling question number 2. And again, as just a reminder, please answer 75% of the questions if you'd like CE. So has your company performed transfer price analysis? So simple A, yes, B, no, or C, you're not sure. And again, I know some of you have been asking that the presentation and the audio recording will be available after the webinar. I'll be able to send that out to you all, so no worries if you need that or like to listen to this again, because I know we just covered a lot. So we'll close the question here in 3, 2, and 1. And I'll turn this over to Kevin.
Wow. I mean, that's a nice split. I mean, 52% have said yes, and 44% have said no. That's probably not too uncommon in terms of what we see in the marketplace, but that's a nice segue into our next topic. So we do want to talk about transfer pricing, the importance of transfer pricing. But first of all, let's just talk about, what is transfer pricing? What are we talking about? I mean, technically, we're talking about the transfer prices that are charged on the transfer of goods and services between related parties. But really, what are we talking about? We're actually talking about the apportionment and allocation of profits around the world. If you look at here in the United States, we're familiar with state income tax apportionment. So we have a company in the United States or a group of companies operating in the United States, and they operate in several states. Well, how do the states actually carve up that profit? There's only so much tax that they can fairly take from the taxpayer. And so how do we allocate and apportion the profits? Well, at the state level, it's a formula-driven approach, and based on some form of sales, property, or payroll. At the international level, we're actually concerned about the same thing. And so you have a global group of companies that, let's say in aggregate, have a global profit. How do we allocate that profit across various countries in which that group operates in? Well, instead of using sort of the state apportionment approach, which the OECD has completely rejected as being too arbitrary, they use transfer pricing. And transfer pricing is designed to carve up that piece of pie, that pot of profits across various countries in which the group operates in. And so the basic tenet of transfer pricing is that intercompany transactions must comply with the arm's length standard. The arm's length standard is quite simple. It says that transfer prices between related parties for goods and services should be at the same prices as transactions with unrelated parties. So it sounds pretty simple, but not so simple always to implement. And so transfer pricing regulations and legislations really affect nearly all intercompany transactions, whether it's transactions for goods, services, licensing, royalties, or even lending transactions. Transfer pricing compliance has to be considered. So why do we care? Well, I've already touched on it to some extent, but if we don't care, the governments certainly do care. And so each company that has any cross-border international transactions has to justify the intercompany pricing to tax authorities upon examination. And as evidence that the countries have taken this so seriously, transfer pricing penalties tend to be the most significant penalties in the tax legislation, including here in the United States. The transfer pricing penalties are some of the highest in the Internal Revenue Code, with the exception of fraud penalties. And so the government has taken it very seriously, but the good news, being on the forefront of your transfer pricing policy and having the right documentation will eliminate or at least mitigate these transfer pricing penalties. IRS agents today, they come in and they discover that you, once they look at the organizational chart and they see that you have subsidiaries around the world, they are required to request the transfer pricing documentation that is intended to provide them with all the detail that they need in terms of the type of transactions that are occurring and the transfer pricing or transfer prices that have been chosen by the group. Oftentimes we hear companies say, well, it really doesn't matter. We're in startup mode. We're burning through cash. We're just building market share. And so we have a global loss. And so we don't really have to care. Well, you do have to care, and we'll get into that a bit. But you have to care because if in a typical situation where you have a U.S. parent, and the U.S. parent has developed all the intellectual property and know-how and has all the people that the founders are here in the United States, and they decide to expand globally, while the U.S. government believes that the U.S. parent is entitled to the lion's share of all the global profits because all the intellectual property resides here. And so that if you have foreign subsidiaries that you have formed on your own, organic subsidiaries, and they're making losses, the foreign country may have an issue with that company making a loss because that company essentially is only a service provider to the U.S. parent and should not have any losses under transfer pricing principles. And John will get into this a little bit later, but transfer pricing is really the heart and soul of a successful offshore IP structure. So quickly, just going through steps on implementing a transfer pricing policy. Really the center of a transfer pricing analysis is the economic analysis of the intercompany transactions, or what we call benchmarking. This is a economist report that benchmarks what your company is doing in a foreign jurisdiction to what unrelated parties are doing in the same region and in the same industry, and measures what sort of profit these third-party comparables are getting on the same activity. And so that's how we measure the amount of profit that say a foreign subsidiary should have on intercompany transactions. So the economic analysis is really, again, the center of the transfer pricing policy and is the first step. The next would be the documentation of the policy, and there's various degrees of documentation that we can't really get into today, but needless to say, the IRS regulations, the documentation required by those regulations is quite robust. Drafting the intercompany agreement. That's very important, because once an agent comes in and says, well, I identified intercompany transactions, I want to see the intercompany agreement that sets forth the terms and conditions that the parties have agreed to, including the pricing. Operational implementation, obviously, is going to affect internal accounting. There should be, the best practice is invoicing between related parties. That's one thing that we oftentimes see missing. And so there's certain operational effect to implementing a successful transfer pricing policy. And lastly, monitoring and update as necessary. In other words, this is an ongoing process. If the facts of your organization change, then the transfer pricing must also change with it.
And maybe just to point on that operational implementation, as Kevin mentioned, the intercompany invoice is really important. But just to kind of use an example of you have a U.S. company with a sales and marketing service entity in the U.K. First thing you need is the intercompany agreement that spells out the rights, risks, and responsibilities of each party. Then you have to develop the pricing associated with that cost plus 5% or 7% or whatever that benchmarking analysis results in. And then the intercompany invoice has to show the cost base as well as the markup from the UK to the US. That invoice needs to be produced and sent, booked and recorded in each jurisdiction. So you're recording revenue in the UK and an expense in the US. And then, very importantly, the US has to actually pay that invoice. That's probably the piece that's very often overlooked, because they don't want to have the foreign subsidiary to have a cash buildup of that markup or compensatory element, and therefore quite often that plus is not paid over, only the cash that they need to operate. And what that can result in is other subpart F and other U.S. tax implications to not making those payments. So really, that operational implementation and monitoring is very critical as things continue to expand internationally for a company, because many of these details can be set aside and cause significant problems down the road.
Yeah, I think that's an excellent point. And the other thing oftentimes we see is that when a company initially expands outside the United States, they oftentimes view it as the foreign subsidiary as an extension of the U.S., or in cases sort of the foreign subsidiary in isolation. In other words, they view it as from a business perspective. If I have a subsidiary in the U.K. and I hire some sales folks in the U.K. and we generate customer revenue, that revenue has to be recorded in the U.K. and all the expenses are recorded in the U.K. and then whether I have a profit or loss depends on the UK market. But that oftentimes, under transfer pricing economic theory, is the wrong approach. That foreign subsidiary, again, because the IP is here in the United States, that foreign subsidiary is just a service provider to the U.S. parent, and therefore, suffering a loss, it would be oftentimes inappropriate. And that oftentimes comes as a surprise to some people, in the finance role.
Yeah, and so planning, as you expand overseas, this is one of the key pieces of planning transactionally. Who is going to contract with the customer, and whether it's the U.S. company or the foreign entity, what are the implications of both those from a business and operational perspective as well as from a tax perspective. And then once you have all those facts, you can make an informed decision on what path should be taken, because there's also transactional VAT, sales tax type implications to how the transaction is structured as well. We need to keep moving, but we did have a couple of questions come in from the audience. One of them has to do with if you have a U.S. company or in a foreign subsidiary, or a foreign parent in a U.S. subsidiary, who is responsible for doing transfer pricing analysis, and to which of those entities does all this transfer pricing rules that you mentioned, which companies does it relate?
Well, actually, I mean, it's a bilateral arrangement, so it actually applies to both. And so it depends on the country that you're dealing with. But you really have to have documentation that really ought to satisfy both countries. And again, it depends on the country that you're dealing with. If you're dealing with a European country, oftentimes the rules between the European country and the United States are very similar. And so you would get one transfer pricing report either in accordance with the OECD guidelines or the U.S. transfer pricing regulations, and that would be sufficient for both countries. That's not always the case, such as in India, in other places.
Yeah. But yeah, good point. Yeah, both sides have to deal with transfer pricing, and both sides require a level of documentation. Yeah. Moving on to our next polling question.
Thank you, John and Kevin. All right, polling question number 3. You'll see is your company considering an offshore IP?
Structure.
Sorry, left that off. So A, yes, B, no, or C, you're not sure. Give you a couple seconds. I'm going to close the poll in 3, 2, and 1. And I'll turn this over to John.
All right. So, yeah, so it looks like about 35% yes, 46% no, 20% not sure. And we'll talk a little bit more around the benefits and risks associated with having your intellectual property, the economic rights to exploit it offshore. And that's one thing I just want to talk about as we move into this is what is an international IP structure? What is global entity, global minimization type structures. Now, essentially what it is, and one of the benefits is the shifting of profits that correlate to the shifting of risk from one jurisdiction to the other. And we talked about a little bit under the BEEPS analysis, but this really is economically justified and sound, and is why about 70% of technology companies have some sort of intellectual property structure, let's call it in general. Now, the benefits are essentially that, and again, typically the non-U.S. sales would not be subject to current U.S. income tax. That means that that's typically how we split it. You can do all of your sales offshore. It just depends on the nature of your business, the supply chain, and what's involved in selling the product. But essentially, we want to target a rate of somewhere around 3 or 4% for those international sales associated with that intangible property, and as opposed to 40% in the U.S. And so as you can tell from that rate differential, there's no doubt that there's a potential reduction in your global effective tax rate, or ETR, that's available. What's the result? Increased earnings per share, always on the top of mind of every CFO and CEO. One thing to think about when it comes to these structures is that this is a tax deferral structure. And what that means is that the taxes or the income that's associated with these sales and this profit is deferred from U.S. income tax until that cash is repatriated to the United States. Once it is repatriated, then it is taxed at full U.S. rates. And so this is one reason why Apple has $100 billion offshore, but needs to borrow $30 billion to do their stock buyback and dividends and whatnot. Typically, companies are not in that situation, but if you're the next Apple, it's definitely something to consider. It's getting along that path. Typically, the cash is used for offshore activities, acquisitions, and global expansion. And so typically, companies do not have an issue with continuing to indefinitely reinvest those earnings overseas. Some of the considerations, just really quickly, is that this is not a paper transaction. There is typically changes in operations. There's increased compliance as well as accounting to make sure that everything operates correctly. And it is subject, as we talked about before, subject to scrutiny from both the U.S. and other tax authorities. So what does it entail? The key requirements, and we'll actually talk a little bit over these requirements off the next slide, which shows it's kind of the basic structure. So typically what we have with an international structure is we have a company that's located in a low-tax jurisdiction. Ireland is what's used in this example, where the tax rate's lower than the sales entities. In this case, we have what's called a double Irish structure, and this is one that some large public technology companies have been in the press over the last 6 or 8 months.
In particular, Apple, right? I mean, they had to go before Congress and talk about their double Irish structure, but Apple uses this structure.
Very kind of. It's a little more complicated than this, of course, given that they're Apple. But HP was also testified before Congress. And again, we do not foresee any real changes in the ability to plan using these type of structures. But just to kind of quickly go over transactionally how it works is that Irish company acts as the operating entity for the non-U.S. sales. It pays a royalty out to the Cayman company, who then enters into a cost-sharing arrangement for the further development of that IP. Now, in this structure, the Cayman entity owns the economic rights to exploit the intellectual property outside of the U.S. And the U.S. company retains all title to the IP as well as the rights to sell in the U.S. So from a IP defense perspective and trademark protection, those type of things, the U.S. company is that face to the IP. The Irish operating company enters into agreements with the contract manufacturer to produce, let's call it the semiconductors or the box, whatever it might be that we're selling, or from an internet perspective, they are having ownership of servers that provide the service over the internet directly to the non-U.S. customers. They then pay a royalty to the Cayman company for that further use of that IP. So while the Irish tax rate is only 12.5%, the tax rate in Cayman is 0. And so the effective tax rate around a structure like this is typically somewhere between 2 and 5%. And so it's very powerful. You would then have your other subsidiaries, sales subsidiaries in the UK, France, Germany, Taiwan, Korea, wherever it might be, located underneath of this Irish structure. And all of those entities would be treated as one group entity using the check the box or disregarded entity provisions of the U.S. tax code. So just in a nutshell, that's the basic structure. But it does require substance, and that's one of the key things that BEEPS and some of the U.S. provisions are looking at. So you do have to have people outside the United States within that group structure to be able to effectuate the transactions, the approvals, the sales, the invoicing, all those activities that correlate with those non-U.S. sales. And so typically we like to think of their imaginary line between the Irish group entity and the U.S., and as much as possible associated with those foreign transactions occur outside the U.S., but are always available to be reviewed in the U.S. from a stewardship perspective, as well as the R&D can be located both within and without the U.S., whichever is most conducive under the operational constraints of the company. So why enter into one of these types of structures? As we talked before, there's significant benefits to having these structures from a tax rate perspective. They are tried and true, I guess is the way to say it now. Microsoft and Apple have had these types, and other large technology companies have had these structures in place for decades. This is not a fly-by-night or risky proposition from having it not being tested by the IRS.
I think that's a very important point. People oftentimes look at this and say, well, this is a tax shelter. And it's not technically a tax shelter. It's actually a sanctioned method of managing your intellectual property. And in fact, there are IRS regulations directly on point that deal with this issue. And so the risk of this type of structure is really implementation and operations of the structure.
Yep, implementation, really making sure that everything's being done the way that it's set out, and that the risk is really around the valuation of the IP.
Yep.
And that's where the IRS tends to, put their efforts behind that. And that's where we've seen a number of court cases as well as large settlements with the IRS, usually in favor of the taxpayer, actually almost exclusively in favor of the taxpayer, with regards to how that IP is valued when it's moved out of the U.S. to the non-U.S. principal. So, and if you have any questions on this, we can kind of hit it at the end. But I do want to leave just a few minutes for questions at the end. So I think we'll go on to our next polling question.
Perfect. Thank you, John. This is our last polling question. So if you haven't answered one, please answer this one for the CE. And the question is, where is the best place to locate an IP holding company? A, Ireland, B, Cyprus, C, Singapore, or D, it depends. I'll give you a few seconds to get your answers in, and we'll close the question in 3, 2, and 1.
All right, so yeah, this was a little bit of a trick question. Ireland, Cyprus, and we'll excuse the spelling on Cyprus, but and Singapore are all jurisdictions where you can locate offshore IP structures. Cyprus, given their banking issues, is a little lower on the totem pole, but there are a number of jurisdictions that are very beneficial from a tax structuring perspective. They include Ireland, Singapore, Netherlands, Switzerland. The UK has a beneficial regime. Yeah. Singapore, Hong Kong, Macau, Malaysia. There's a number of jurisdictions around the world. And part of the magic, if you will, around IP structuring and advice around that is determining what country best suits your business. And so the answer is definitely it depends. That said, I do want to just talk. There was a question that, and we have a number of questions that we'll talk about here in the last 5 minutes, but one specifically related to the IP structuring, and that is, when does it make sense to implement it or consider an IP structure? That is a great question. I couldn't have put a better question if I had loaded it myself. There's a couple of triggers that we generally look for to say, does it make sense to have to think about, or at least do a feasibility analysis around an offshore structure. One of the key elements is the fact that you expect your company to expand globally. And from that I mean to have significant offshore sales and profit associated with that. Typically the benchmark that we use is if you have a gross margin less than 50%, 50%, we typically want to see at least 15 to 20% non-U.S. sales, either anticipated in the next several years or currently. If the amount of sales is in excess of that and your gross margin is less, then obviously it makes sense to investigate. If your gross margin is higher than 40 or 50%, the benefits in offshore structure can be realized even at a 10% or below rate of international sales, especially if the operating income, if you're profitable. If you're not profitable, then you look more towards a higher percentage of international sales. because it can take a little longer to realize the benefits. And it also coincides to when you do expect to be profitable overall. If you're incurring losses in the U.S. can be a great tax haven. Although another one of the triggers is that it's important to remember that as sales continue to increase for a product, the value associated with that IP, and hopefully profit is correlative to the sales, but the value of that IP increases on a daily basis. And so the sooner that you do an IP transaction, the less it's going to cost from a U.S. tax perspective for that buy-in. The other trigger that can be important is if you have a valuation allowance against your net operating losses, doing an IP transaction before you release your valuation allowance can be beneficial from a tax rate perspective and a financial statement presentation perspective. But the real answer to that is it depends. To kind of go back to our polling question, it really is on a case-by-case basis, and of course I'm happy to talk with anyone around their individual facts and how best to think about implementing an IP structure. That said, there are a couple other questions that we can hit on in the last several minutes. And again, if you do have a question, please post them to the little question box. What are the U.S. tax implications of not paying the plus part of your cost-plus arrangement with a foreign subsidiary? Kevin, maybe you want to tackle that one.
Well, you can't handle that one? So what are the risks of not paying the U.S. or paying the plus to your foreign subsidiaries? Well, if you're not paying the plus and then you're building a receivable in the foreign jurisdiction, if I understand the question correctly, and so if you just continue to build up that receivable and just fund the operations of the foreign subsidiary, that receivable can be considered a deemed dividend back to the United States under Section 956, and so the U.S. Parent would have to include that receivable into income
immediately.
Immediately,
yeah, as opposed to being able to
defer
that profit. And so that can be a very sizable amount if over time, especially if it's a large cost plus subsidiary. I've seen companies that can have in excess of $5-10 million that is in that plus. Of course, when it's smaller, it's not quite as relevant. One thing again, we have 3 minutes, and so I did want to just hit very quickly on the entity choice. I noticed that I slipped over that slide. I'll go over that in 1 minute, and then we'll be able to do one more question. But the one thing around entity choice is as you expand internationally, we typically like to put our footprint in the foreign jurisdiction as lightly as possible until we're confident that that's going to be a jurisdiction and an office that is going to be in existence for a while. And so the hierarchy that we typically use for expanding internationally is first, if we're going to hire someone in France, for instance, first step is, can we hire that person as a contractor? And can we hire that person through an agency that's going to insulate us from permanent establishment risk, from payroll tax risk, from having any sort of taxable presence in that country risk? If we decide that, we have to have that person be an employee, the next step up is, can we register the U.S. company as an employer in that jurisdiction to take care of our payroll risk and other obligations? What are the activities of that employee? Can we use a tax treaty to not run afoul of permanent establishment issues? The next one up from that is, if we do need to register something in that country, can we do it through a representative office? And these are dependent on the type of activities that are being performed by that employee in the local jurisdiction. The next step from there is a branch. So a branch is now a taxable entity in that jurisdiction. How do I minimize my presence there? Do I use a branch? Do I use a subsidiary, which is kind of the more formal presence in a country? Most European countries have changed their rules such that it's not very beneficial at all to be a branch there anymore. You typically will go straight to a subsidiary from both the cost perspective as well as the taxation perspective. And so as you expand internationally, you want to kind of evaluate these different options that you have, these different considerations. And typically what I recommend is to contact a international tax service provider to assist you through that process, because it is very dependent on the country that you're dealing with.
Yes.
The highest risk of anything is the payroll tax risk, and so you never want to be hiring a contractor to where you pay them directly to their bank account. Almost guaranteed, I think the last statistic I saw was about 70% of contractors located outside the U.S. do not pay tax on the money that is paid to them when it's not paid through an agency. So just a very cautionary, there are many tales of problems with that and huge tax bills with it. So that said, we are do not have time for any additional questions, and so if you do have a question that was not answered, I noticed a couple up there. Those will be forwarded to me via email, and either Kevin and I will respond to you via email on those.
Thank you, John and Kevin, and thank you all for joining us. And as John said, we'll get back to any questions we missed. For those of you who are needing CE, you'll be receiving an email within 3 business days with access to your certificate, and please complete the survey at the end of the webinar. Thank you all, and please join us for one of our upcoming webinars. Thanks again.